All right, hi everyone. Welcome to today's webinar on how to trade gold. Okay, let's just wait for a minute or two before everyone to tune in. Just before we start, I'm just going to launch a poll. It is just for just to know whether to find out how many of you are first-time attendees. So please respond accordingly. We'll really appreciate how many guys, how many folks are tuning in for the first time as well. Right. Hi, Bob. Hi, Adrian. Right. Okay. Okay. Can you guys hear me loud and clear? Just want to make sure audio is good, and I assume you can see my slides as well. IC Markets webinar: How to Trade Oil. All right. Thank you, Adrian. All right. Okay. Yes. Let me make sure everything's good. Okay. All right. Thank you, Adrian. Sound is good. All right. Excellent. Oops. Okay. Okay. All right. Thank you. Good as well. I hope I pronounced that right. Okay. All right. Okay. So far, right. Okay. So we got half of the attendees who are first time viewers, and the rest of you are repeat uh, attendees. All right. Great. Great. Great to have all of you on board today. Okay. So let's just start things off. All right. Of course, first of all, the disclaimer as well. Okay, so the information that will be presented in this webinar is purely for educational and information purposes. It should not constitute as investment advice. And also do take note that CFDs come with a high risk warning. They are complex instruments, and there's a high risk of losing your money rapidly due to leverage. Okay, and okay, so all right. Okay. And okay. So my name is Ketan Ramachandra. I'm an investment analyst at Everest Fortune Group. So this webinar series brought to you in special partnership with Everest Fortune Group and IC Markets, where at EFG we've been the finalists for the best FX and equity research for from 2019 to 2021. All right. Okay. Okay, so here's what we'll be looking through today. And of course, we'll also be looking at some of the current trade setups based on current news as well. Okay, so we'll just start off with demand and production just to get a quick overview of which are the biggest oil producing countries as well as the biggest consumers. Then we'll take a quick look at geopolitical risks, how risk events over the years have caused oil prices to spike and also to collapse. We will also look at US crude oil inventories, how to track them, and how can we use them in assessing whether demand is strong, increasing, or decreasing in the US. And also, lastly, we'll have the data link so you guys can take a snapshot of that slide, and you can explore those websites to find out more if you wish. And of course, at any point in time, do not hesitate to drop your questions and to clarify any point or to ask for anything that you would like further clarification on. Okay, so we'll start off with demand and production. Okay, right. Okay, so this is the EIA, this data is from the EIA website, so which is the US Energy Information Administration agency. So as you can see, okay, let me get my laser pointer on. So where is it? I remember last time. Okay, wait. Right. Okay. All right. Okay, this should be easier. Okay, so I've got my laser pointer on. Okay, so what we're seeing here is the world consumption figures of crude oil from 2017 to 2021. So as you can see, okay, this is in the terms of million barrels per day. Oh no, sorry. In this case, it is this M. Okay, just to clarify, this M doesn't stand for million. It stands for thousand. So what this means is 99 thousand times another thousand. Okay, so this M here stands for the thousand. So 99,000 times thousand gives you 99 million. Okay, so we are looking at 99 millions of barrels consumed in 2017, and it was steadily increasing till 2019. We hit 100 just over 100 million barrels per day. And of course, with the COVID lockdowns, we can see oil demand or consumption dropped pretty significantly, almost a 10% drop, right? Of course, economies and countries started opening up gradually, perhaps in the second half of the year, and that's where demand also would generally started picking up. Oh, okay, sorry. Let me close this poll then. Sorry. All right. Thank you, Bob. Oh, can you only see the poll screen? Oh, hang on. Sorry. Wait. I'm not. Hang on. Screen two. Nope. Okay. Sorry. Just before. Okay. Do you guys see the slide for the EIA world consumption? Right. I believe the poll screen is off. Right. Sorry. The poll. Yeah, I forgot to close that. Apologies. All right. Okay. Thank you, Andrew, Adrian, Bob. Okay. Right. So, okay. You guys. Okay. Did not miss much. So we just went from. Yeah, we covered the introduction, the disclaimers, the agenda, and we're now in demand and production. Okay, so so of course with the COVID lockdowns, pandemic lockdowns, there was a significant drop in demand for crude overall consumption, and then in 2021 it picked up again. Okay, so these are just figures to understand what is the consumption of crude oil at a global level. All right. Okay, this data is from the CEIC, is the Center of Economic and Consensus for Economic and Information Center. So we get this. Sorry, it's the Census and Economic Information Center. Okay, CEIC. It's an agency, Census and Economic Information Center, and this data is accurate as of 2021. So the United States is the largest consumer of oil, followed by China, India, Russia, Japan, and if you take the, let's just say the top four biggest consumers in Europe, you get about 5.9 million barrels per day for them. US is 18, China 15. All right, so these countries make up roughly make up almost 51.5 made up 51.5 million barrels of consumption per day in 2021, which accounts for almost half of the global consumption. All right. Okay. Now this is the API, which is the American Petroleum Institute, is one of the agencies in the U.S. that tracks um, crude oil demand in the U.S. across the various what do you call it products, right? Because crude oil can be refined into various products such as distillates, jet fuel, motor gasolines, and so on and so forth. Okay, so this shows you the breakdown uh, of the demand for the particular product as well as the overall demand in the US. So naturally, we can see as economies shut down in 2020, there's a significant drop in demand, and after that, demand started picking up. The thing about this website is because it's only updated on a monthly basis, so it's uh, it's not it gives you a good idea of where the current demand level is, but it's not something that you can probably use for on a to have like frequent updates, but just to understand how the demand is actually trending in the US. Okay, so now we've touched on demand, we'll just quickly go on to production. So not only is the US the biggest consumer of oil, they are also the largest producers. Like naturally, you would think that Saudi Arabia would be the largest, but I think maybe now they are currently with the in 2022-23 perhaps. But based on 2021 data, yeah, the US was the largest producer, followed by Saudi Arabia and Russia third. So that is why oil spiked up as well last year in February, March, and April, especially after Russia invaded Ukraine, right? All the allies um, were had started imposing various sanctions on Russia, sorry, particularly on their exports of natural gas and oil, and that 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 meant that there was less supply coming into the market for these two commodities, and hence the prices for these two commodities spiked. Okay, so the stars, the asterisks, the red asterisks or the stars highlight OPEC member countries. So as you can see here, out of five out of the 9 largest oil producers are OPEC members. Okay, so you got led by Saudi Arabia, Iraq, UAE, Iran, and Kuwait. So this is also important because whenever OPEC announces surprise cuts, like what we saw in April, I believe, right? 1 or 2 months ago, they announced surprise cuts together with OPEC plus members. It makes a significant impact on the supply of oil coming into the market, right? When you have 5 out of the 9 largest producers part of OPEC, and this doesn't include OPEC plus members, which Russia is part of, and when you have this group or this organization announcing supply cuts or increased production, it will have a significant impact on prices as we saw in April. Okay. Then imports. Okay, this is also important because we need to know who are the biggest importers. So naturally, I mean, it's not naturally, it's not surprising to see China being being the largest uh, importer of crude oil. Of course, they have the second largest economy in the world. They are the manufacturing factory, or they're the global manufacturing factory uh, for all your for or not all, for majority of your products. So naturally you would expect them to have a very high consumption of oil given their geographic population size and the level of and the size of their economy. So part of the reason why earlier in the year perhaps there was a strong bull case for oil was because the reopening of China. When you have a country that's importing about 10 million barrels per day, there is a strong demand. So when uh, China finally ceased all lockdowns and they started to reopen their economies, their states, their cities, and their not states, sorry, their provinces, their cities, and of course their economy. Many analysts and economists were expecting a strong demand coming in from China, but the rebound in China has not progressed as what many have expected. And as you can, if you are also looking at the PMI data that have coming out of China, the recent ones uh, have showed uh, economic activity not to pick up as strongly as many were expecting. And also the recent trade balance data also showed that China had imported less barrels. I can't remember the exact figure, but it was quite a significant uh, value. I mean, significant number of barrels. They had actually imported much less barrels than what they generally import on a monthly basis. Okay, so this is why looking at China is also important, because you need to know whether uh, they are growing actively and are they continuing to import oils at a steady and a growing rate. Okay. All right. Just a brief uh, uh, coverage, because what I'm trying to put across here is sometimes we'll definitely see news headlines hitting the wires about oil's supply cuts, production cuts, and so on and so forth. So it's important to pay attention to these bits and pieces of information so that we can quickly try and assess what is happening with oil prices, right? So in 2014 to 2016, there's a big supply glut, okay, uh, which was prim- primarily driven by supply factors, because we had the booming U.S. oil production. I believe this was during the big shale production in U.S., and also OPEC policies as well, shifting OPEC policies. So when you have a lot of supply coming into the market, and you have OPEC adjusting their policies, and you have global demand pulling back as well in terms of economic activity, and which naturally leads to lower consumption of oil, you can end up in a scenario where, like in 2014, 2016, uh, oil prices had a big drop due to uh, the massive supply glut. Okay, geopolitical risks. Right. Okay, this is a very nice chart which I found recently. You can go to this website here to check out the article and read more about it. As you can see, these are for the last 50 years or so, how certain how major political and economic events have caused oil prices to spike and collapse as well, right? So from 1971 to 2022. So let's just start with the most recent one. Like we saw 2022, Russia invades Ukraine. So that's when we saw a big spike in the uh, price of oil. And of course, we had the 2022 global pandemic where there's a significant drop. We saw prices collapse. And also, if you're looking at the futures contracts as well, you would have noticed or may perhaps seen that headline that oil futures prices went negative. And then here also OPEC production quota unchanged despite low oil prices. So that means they were still, I believe they were still producing, they were oversupplying the market as well, which lines up with the uh, 2014, 2016 supply glut. So you had the combination of uh, increased production in the US because of the shale uh, pro production coming from the shale activity, and also you had OPEC who did not uh, reduce their supply as well. So there was a huge flood of supply coming in from the US and OPEC members, a huge supply of crude oil coming to the market by these two, well, by the US and the OPEC member countries. So that is why we had this big drop in crude oil prices in this period. All right, so I'll just leave this chart and the website for you to explore more in detail. So it is also quite important to realize. Okay, what is also important to highlight is we can see generally when such uh, geopolitical events take place, like for example in 1990 and in 2001 when Iraq invading Kuwait and the 9/11 attacks, oil spiked going into these events, right? But they quickly reversed as well. So you just have to take note that um, um, whenever such uh, uh, geopolitical risk events take place, it doesn't mean that oil prices will continue to rise higher, right? There are other factors at play, and we have to quickly assess and try and determine whether prices are likely to continue or stay elevated, or could they potentially reverse. Right. Similarly, in 1980, during the Iran-Iraq War, prices stayed elevated for a certain period of time before this gradually started uh, retreating down. Okay, crude oil inventories. Okay, so this is the EIA crude oil weekly stock. So this data is updated on a weekly basis. So we are able to see the inventory levels of crude oil in the US. So once again, this M stands for thousand. So what we're looking at here is 550,000 times another thousand. Okay, so that means we have 550 million barrels. So this is what we are looking at in terms of quantity. So currently the US crude, okay, this chart is not updated, but I'll take you to the website where we can see what is the current uh, level of crude stocks. So this figure here is actually referring, it means that we are looking at 475 million barrels in inventories. Okay, so do we look at crude oil weekly stocks? Because it generally gives us an insight into uh, the demand of crude oil in the US. Like in the earlier slide, we had the API slide, which showed the monthly demand for crude oil, but that's too slow, right? The data points do not come in frequently enough. And for this, at least we are able, because this data comes in is released on a weekly basis, we're able to determine whether crude oil consumption is increasing or decreasing. So a simple way to do it is basically when you see crude oil stocks increasing, that means there's an inventory build. So inventory is actually increasing week after week. That generally means that uh, demand could be pulling off, right? Of course, you cannot look at any data point in isolation, but you have to use them and combine it with other factors as well. So just in this case, just we are looking at oil uh, stocks building up in the US. So generally, perhaps this would perhaps be indicating that oil demand is pulling back. And conversely, when the inventory level peaked and started declining pretty rapidly, then we can probably, or we're not probably, we can we can assume that demand is picking up. But of course, we have to uh, check with other active factors as well to see whether is this really happening. And of course, price is the best action to tell you whether there's demand or if there's strong demand or a lack of demand for crude oil. So similarly, in 2023, you could see crude oil stocks building up pretty. It is not 20. Okay, we'll go into the chart where we can actually see where we are in the timeline. Okay. Okay, this is SPR crude stocks in the US. Okay, this is quite important because okay, SPR stands for Strategic Petroleum Reserve. So what happened after the Russian the Ukraine invasion of by Russia was because oil prices were spiking, commodity energy prices were spiking. Uh, the U.S. government, basically the Biden administration, authorized the release of crude oil barrels from this strategic petroleum reserve. So this is a special reserve for the US that they only draw down on in times of crisis. And uh, last year, the Biden administration they came to the consensus that because of rising inflation and potential cost of living increases in cost of living to US households, they decided that they would release crude oil barrels from this reserve and supply them into the market. So as we've seen earlier, whenever we've had a big introduction or big supply of crude oil coming into the market, it generally is more than likely to push oil prices down, even though demand may be steady or growing steady or growing at a decent rate. So you can see previously, prior to the release of the crude oil barrels from the SPR, there was about 600 million barrels in stock, or well above 600 million, and they've released it at a pretty significant rate. Of course, they did it in stages. I believe there were 2 to 3 instances where they released the barrels over the course of the year. So they started in April. The first release was in April, and then I think they followed up in the second half of last year as well. And currently, the reserves are sitting under 400 million barrels of crude. So this news was also well, this news would have been covered right in the headline as well, and it's important to pay attention to such news because when we see a huge supply of barrels coming into the market, it's very likely crude oil prices will retreat, and that is what we saw as well throughout the second half of 2022. All right, so this is what I would just wanted to point out as well. So, all right, okay. So before we look into the charts, after this we'll move on into the charts. But here are some of the data links that I use for today. So if you would like, you can quickly take a screenshot, and then I will move on onto the charts. All right. Okay, so now, okay, so here I am on trading view, right? Okay, so let's just zoom out a little bit first onto the weekly chart first, just to get an overview uh, what how crude oil prices has reacted over or performed over the last few years. So okay, this is in January 2020, uh, before the pandemic lockdown. So you could see oil prices were already pulling back, and of course with the lockdowns, oil prices crashed, and some of the futures contracts even went into negative territory. And then after that, once economy started opening up gradually, we saw crude oil pick up, increase in price as well. Okay, then okay, so here we are in January 2022, where we had this was before the invasion, the Russian invasion of Ukraine. So we had oil prices dip here as well, I think due to economic concerns and slowdown. And then after that, it started to pick up. And of course, with the invasion, oil spiked from $90 to as high as $126 per barrel, right? And then we had a big fluctuation, or well, not fluctuation, but big volatile action in the price of oil before finally in June onwards, oil prices started retreating very significantly. So this brings me to uh, the point of the SPR release. So the SPR release was initially, I think the first announcement was made in April, around April, but the barrels once were were not immediately released. Naturally, it takes time to get uh, uh, the physical barrels out into the market. But the official announcement was made around April, and then you could see the oil prices pull back, I believe, due to this the announcement of the statement of the SPR, the approval of the SPR release, and then oil prices continue to raise higher. But I think once the crude barrels started physically hitting the markets coming into supply, that is when we see crude oil price retreat, and they never looked back, right? It just went down uh, in a pretty clear fashion. So that is why it is important to take note of um, such news events, especially if you're trading oil. Take note of it all. Practically, basically, it all uh, boils down to supply and demand, right? Over here, economies were still growing relatively steady. Oh no, sorry, this was also the period where because the first half of 2022, uh, the U.S. economy fell into a technical recession, where they had two consecutive quarters of negative growth, but that growth was actually relatively shallow, and the US economy actually bounced back very strongly in the third and fourth quarter to register a strong rebound. And for Q1 and Q2 of this year as well, the US economy is uh, pretty steady as well. So the combination of a technical recession slowdown in the first two quarters of 2022 in the US, followed by a lot of recession concerns coming into the second half of 2022. And you add that with the supply of, or the additional supply of crude oil coming in from the SPR, was driving oil prices down as well. Okay, so by being aware of such headlines uh, and also paying attention to like the inventory levels, like I've shown you the websites where for the EIA crude weekly stocks as well as the SPR stocks, you're able to at least track those inventory levels on a weekly basis to see exactly how uh, sharply or how shallow is the rate of uh, uh, how short is the sorry is the supply being sorry, the inventory being drawn on, right? So if you have week after week of huge drawdowns in the inventory or in the SPR, then it means that there's a lot of crude oil coming into the market. Okay, then right, so pretty much the second half of 2022 was being short oil generally. Of course, there's always rebounds and retracements to play once you reach certain support levels, but generally the trend for the second half of 2022 was short oil, and whereas the first half, basically it's a mirror image, right? So from the first half for oil from December of 2021 all the way to about middle of 2022, generally it was a bullish trend in the price of crude oil, and in the second half onwards it was the complete opposite. All right, and then okay, which draws us to this point in time in November, because this was when the last of the barrels from the SPR hit the market, right? So when all the barrels that were authorized to be released uh, were done, right? They all came into the market, and there was no further additional crude oil to be released from the SPR. Supply, we can uh, assess that supply would have pretty much stabilized, right? There's no additional barrels coming in. Supply has stabilized. Demand was relatively stable as well. So this is why we can see that crude oil prices, WTI prices, range between roughly between like $71 per barrel and $81 a barrel. So you could have seen this on a slightly. That is why I like to just do view charts on a weekly and daily time frame first, so as to establish longer term trends, and then from there you can zoom in onto like the H4 charts or the hourly charts and try and find opportunities to go long or short depending on your trading style and strategy. So in this period, when the last of the SPR barrels were drawn and supply had stabilized, demand was also still relatively strong, you could see crude oil prices just range between $70 and $80. So okay, why did it drop here in March, right? You, if you guys remember during this period, right? Why did crude oil prices drop here? Well, basically it was the regional banking crisis, right? Silicon Valley Bank, First Signature Bank, all those issues came to the forefront, and um, bank equity markets were pulling back strongly. The regional bank ETFs and the bank stocks themselves were all dropping like a rock. So why would a banking crisis cause such a pull, such a sharp pullback in oil prices as well? Because when we have an potential banking crisis, people or markets will assume or not assume, will start to figure out whether this will start to assess whether this banking crisis could lead to a potential systemic risk in financial markets, which could potentially cause a major recession. So when you have a major recession, or the probabilities of a major recession occurring, or systemic risk to financial markets occurring, that means we will see economic activity slow down and pull back very sharply. So hence oil prices will also pull back as well. Yeah, hi Richard. Yes, okay, we're going to just quickly go into mechanics. Yeah, well, basically that's what I'm going through now as well, right? You have to be aware of the fundamental parts of aspects of oil to see how you can use those uh, data headlines, news headlines, and data points, and then structure the trades. Okay, and then and here during this period, let me just get rid of this, is where you had the supply cuts, right? So the week 27 March, Monday, the on so on yeah on April, the first weekend of April, the last weekend of March, OPEC announced its surprise cuts. Saudi Arabia announced the surprise cuts led with their OPEC Plus members, which caused a big gap up in oil prices, and they stayed elevated relatively for about 2 weeks before they started pulling back again. Okay, part of the reason was for it to pull back was due to slowdown, perceived slowdown in economic activity as well, looking at the PMI reports and also looking at what I mentioned earlier, China not reopening as strongly as many analysts and economists had expected. So hence we saw oil pulling back as well. Okay, so let's just go into the daily chart now. So, and also we've also had recently the US debt ceiling limit, right? The issue of the US debt ceiling limit. So the outcome of this, the negotiations is likely to push oil prices uh, in the near term. So you can expect volatile action in the price of oil whenever any news related to the US debt limit negotiations come to light. So last week we had failed negotiations, right? Which meant that potentially the US could go into a government shutdown, right? So when the government shuts down, they can't pay federal workers, they can't pay the services for the country, and that means economic activity is going to uh, pull back sharply. So when that happens, oil prices will also tank as well. Okay, and what we had towards the end of um, last week was some renewed optimism in negotiation. That is why we see oil prices pulling back again. So just take note, the most recent uh, headlines that are likely to push oil higher and lower would be the debt limit negotiations. Any positive outcome out of that out of the negotiations is likely to put a floor under oil prices and move higher. And conversely, any failed breakdown in talks and a potential government shutdown is likely to push oil lower. Okay, so now let's just go in onto the daily chart here. Okay, and let's just zoom in. Okay, so you can see on the daily chart we've got the generally a good trend line here, ascending trend line. So do take note of this level here. And now let's just go into the H4 time frame. Okay, so generally we like to, okay, how we how use how do we identify support and resistance levels? We like to use overlapping uh, areas where price action has bounced off, or either to the upside or to the downside uh, at various points. So that is why we use a slightly higher time frame, like the daily time frame or the H4 time frame, to identify uh, support and resistance levels based on the price action of that particular instrument. So in this case, for oil WTI, we can see that, let's just start with the second resistance, that from mid 3rd April to, okay, for 2 weeks in about April, we could see price reacting off 76.60, right? It found support here after the initial um, spike in oil prices due to the OPEC cuts. You could see oil pull back, and you could see it test this level several times, or 3 times at least, before finally breaking down. So by using this identifying um, levels like this, you can use it to put, because it would potentially serve as a resistance levels in the future. So what was previously a support level in towards the end of April turned out to be a major significant resistance in uh, in May. Right. Okay, Richard. Okay, do you trade futures? No. What trading platform do you use? Okay, normally from I would use CFDs as well. So like for example, IC markets, you can use find a WTI or Brent crude oil instrument and use it to trade as well, right? Uh, And of course, if you're using other platforms, it depends. You could buy the crude oil ETF, like a US oil ETF as well, if you wish to go trade ETFs. Otherwise, CFDs like this would mimic the futures price, or at least the front end, the front month running end of the futures contract pretty closely. Right. Okay. Then moving on to the first resistance. So as you can see, price bounced off 73.90 in end of Feb, and then it acted as a relatively decent support level before finally breaking through. And then again in end of March, it served as a resistance level. Of course, price pushed through it before retreating, but you can see how price over time has reacted strongly, relatively strongly off this level, be it as a support or resistance. And here you can see as well in middle of May and also 19th of May. Right, and also we can also like to use Fibonacci retracements. So for example, we can from this low here to this peak, let's just put all fibs up. Okay, for those who may not be familiar with Fibonacci retracements, whenever you use it on an up leg, we go from bottom left to the top right, and on the down leg, we go from top left to bottom right. Okay, so what do these percentage levels tells us? Okay, so they're all calculated based on the Fibonacci ratios. We don't need to get into the mechanics of that, but what uh, these ratios or this retracement level tell us is that once we see price moving up cleanly or relatively cleanly in a certain direction, in this case to the upside, we are looking for support levels. Okay, so when we draw Fibonacci retracements, it is also important to see that the price action of the candle should be relatively close to the trend line. Okay, so let me just highlight the trend line into a more visible color. Okay, this should be fine, right? Okay, so I've highlighted the trend line, the Fibonacci trend line, with a more visible reddish color. So you can see the price action of this candle, uh, the, the price action of the candles here are relatively close to the trend line. So this means this should act as a pretty decent level, right? So what we're looking for now is potential support levels. Once we have seen price peak and starting to retrace and pull back, we are looking for potential retracement support levels, which may line up with the Fibonacci retracement levels and also potentially line up with the horizontal levels that I mentioned earlier. So let's just hang on. Okay. So as you can see here, when we look at this period of in early April, you can see price has, after crude oil spiked, it pulled back and then it was sort of ranging between 79 and 81.20. You could see here that this was acting as a decent support level, right? So it bounced off this level a few times before going higher, and not only did it bounce off this level as a support level a few times, but once it made that peak and price started pulling back, it also lined up nicely with the 23.6% Fibonacci retracement. So this would be a potential support level, and also not only as a potential support level, but because you had seen like a recent swing high here, you could have come to the assessment that, okay, I think oil prices have peaked, and I think we may are likely to see further downside in the price of oil. But where do I find my first support level or potential first take profit area? So once you know we have a swing high, we can uh, determine your stop loss level based on your risk preference, right? It's all after that. It's all boils down to your personal risk management framework, how you structure your trade. So we know we have a swing high, and if we have come to the assessment or conclusion that I think oil prices are going to retreat further, where would be the first support area, and where would be potentially the first area region where I would like to start taking profit on my shorts. So one way to do that is like we have seen the Fibonacci retracement level of 23.6% lined up with this horizontal overlap support as well. So potentially you could have identified this as a support level or an exit level as well. And price did break through, but it bounced back up here, but it rejected it again and started retreating. So once it rejected off this level, right, you have another sort of not swing high, but another resistance level that you have identified. And where would you identify the next support level, right? So lo and behold, okay, because we already had the Fibonacci retracement pulled up earlier. So we can see 38.2% would be the next could be potentially the next significant support level, and lo and behold it did support it, right? So you can see price bouncing off this level a few times, and also of course the horizontal support and resistance levels are only drawn with the benefit of hindsight. You can't do it before, but actually the Fibonacci had already sort of predicted that this level of 7680 could be a potential support area, and it did prove to be that. And then price bounced off it a few times before dropping again. We don't know how far it can go, but again it's lined up pretty closely with the 50% Fibonacci retracement, right? And then once price had reacted off it, it went up to the new resistance at 7670 before pulling back again. So once price went up, you could see that, okay, this also served as a significant support level. And if you just draw the line going back further, you could see that, okay, yes, price did bounce off this level back in February as well. So when you see price reacting off certain levels strongly over or over a period of time, you can come to the you can determine that this is a pretty significant level, and not only in terms of price action, but also it lines up pretty well with the 50% Fibonacci retracement as well. Okay, so this is how we can use Fibonacci retracements together with overlapping support and resistance levels to find out potential uh, exit points or entry points, right? And then finally, oil broke through here, breaking through. Actually, 61.8% is actually a very significant level, but you can see that it did not find any support here as well. So although the Fibonacci retracement levels generally do tend to give you a good indication of where the support levels may be, it is not uh, it's not 100% indicator, right? It's never going to give you 100% uh, uh, I guess result in what you expect from that particular retracement level. Okay, so let's just so you can see how after oil had spiked and started retracing back, you could see how by using a combination of Fibonacci retracement levels and overlaps, horizontal overlaps, you can use it to identify significant support levels and also exit levels if you were shorting oil at this point. Okay, so now, okay, and another thing to take note of, as price moves through the Fibonacci retracement levels, they become invalid. So as it breaks through this level, it knocks it out. 23.6% is invalid. It knocks it out again. 38.2% is not valid, right? So that in terms of retracement levels, they become less significant. And then yeah, then you would need to draw a new Fibonacci retracement to see where would the next potential support and resistance levels would be. Okay, then just as a quick example, because we had that was an example to the upside. Let's do it one for the downside here. So this was a relatively clean move as well in terms of Fibonacci retracement. So when you see price finally bottom at the swing high and start pulling back, you can run the Fibonacci retracement. So the first support, in this case, now we're looking at not support, sorry, but resistance levels, right? So you can see the first resistance level coming in at 23, potential resistance level coming in at 23.6%, but price didn't actually uh, react of it. It actually broke through and hit the 38.2% retracement level. So this is where price ran into a certain level of headwind, right? Ran into some headwind and started pulling back down again. And then the next level was 50, reached through it, and then finally 61. So you can see that in this case, the 23.6% didn't work didn't act as a significant resistance level, but 38.2% fared better. 50 again didn't offer much resistance, and 61.8 was pretty much the same. What actually served as a pretty good resistance level was this overlap here, right? So when price reacted off this level here, it actually started to lose steam over here on the leg up. So you can see how the combination of overlap horizontal levels can help to determine potential resistance and support levels as well. So this I'm just using these two methods, but of course, uh, you can incorporate this with your current indicators as well to see whether do they combine to give you or do they combine well to help you identify significant support and resistance levels, right? Okay, so then this is on the upside. So as you can see, to the upside, only 38.2 percent served as a somewhat uh, significant resistance level, but the others were actually easily broken through. So do not take any indicator use any indicator in isolation, because it may not uh, uh, give us the right I guess insight as for various trading scenarios. Okay, so let's just get rid of this as well. Okay, now we're in a pretty interesting leg of the move. Okay, so these two spikes are relatively long. I'm not sure, because on certain brokers, depending on which broker feed you get, you may not see this spike here and you may not see this low end spike here. So let's just do it from this peak to about here. Okay, or to let's just use this. So I've done the Fibonacci retracement from the top left to the bottom right. So what these levels are now uh, providing us is they're providing us as potential resistance levels. So the 23.8%, I guess you could say it did serve as a relatively strong resistance level, where you could see price consolidate around here, but we didn't see it pull back. It actually started picking up, and where it found significant resistance was around the 38.2% Fibonacci retracement. And not only did it find resistance due to at this level pointed out by one indicator, we also have this existing overhead or this existing horizontal overlap resistance. So you have the combination of two indicators that are telling us that the price level of 73.40 per barrel could potentially act as a significant resistance level, and so it did. So if you had gone long oil around here, seeing that this is a potential swing low, you decided to go long oil, then you would have identified 23.6% as the first potential resistance level, followed by 38.2% as the second significant as a second potential resistance level. But because it also lines up well with this horizontal overlap, this is where you would potentially be looking to exit your positions after going long here, after identifying a swing low and going long on crude oil prices. So recently it's been a very choppy action. As I've said, the combination of the US debt ceiling negotiations plus the slowdown in China, or not slow down, but the relatively slow pickup in economic activity coming from China as well. And also like the recent trade surplus data or trade balance data coming out of China showed that their imports in recent for the previous month showed that they had imported less barrels than they would traditionally do, right? Or well, they would historically do. Okay, so it's been pretty choppy, but okay, so do take note that uh, this of this ascending trend line, price seems to be reacting relatively well off this ascending trend line as well. So if price does break through this trend line in the coming days or weeks, the next support would be at this level here, which also okay. So I'm just going to pull back a little bit to show that in the past, in a December of last year, price had reacted off $70.50 roughly previously and bounced higher. So this has served as a decent support area. However, it didn't give any support here back in March, but it does seem to be lining up relatively well. As you can see, price bounced off here, and also it lines up. Okay, but this technically this Fibonacci retracement level shouldn't be as holding as much significance as the 38 because its price has already broken through it. It has come down and gone up again. So once in terms for with respect to Fibonacci retracements, one price has actually broken through it either to the upside or downside. Generally, that level is not considered to be a very significant level in the future, but it all depends, right? So far, it does seem to it still does seem to serve its purpose, and it also lines up relatively well or relatively close to the horizontal overlap support. So your immediate support levels for currently should be between 70.50 and 71.20, right? And you can see we have a nice ascending trend line, and to the upside, as has been evident in recent price action, the price level between 73.50 and 73.90 is acting as significant resistance. So you could probably try and if you would like, if you still think based on your technical analysis and based on uh, assumption that the debt ceiling negotiations are likely to be positive. You could see if price comes back down around this level, potentially this could be a potential entry point. And then as we know, price has been restricted around this level. So this could be the region of 73.40 to 73.80 could be a potential exit point. Okay, right. Okay, I've come to the close to the end of today's webinar. I'm just going to launch the second poll, and while waiting for the poll to be closed, I'm happy to answer any questions or go through any other technical analysis as well. So let me just launch the second poll as well. Right. So yeah, so in terms of I think so basically when it comes to trading oil, of course we all like to use technical analysis because it's sort of, I guess, easier to grasp as well. But do take note of um, the news events and also the fundamental aspects of oil as well, because sometimes all the news is pretty straightforward, right? When you see OPEC having surprise production cuts, it means less supply for the same amount of demand. So we can expect oil prices to go higher. And similarly, when you see like the US administration approving the release of barrels from its strategic petroleum reserves, this is indicating that there's going to be a huge supply of barrels coming into the market, with demand being relatively stable or perhaps even increasing steadily. So it's just being aware of such headlines with respect to supply and demand, which can give us we can help us point us in the right direction when we're trying to trade oil as well. And like I said earlier as well, I like to start with a weekly and daily chart to identify the longer term trends, be it an uptrend, downtrend, or consolidation, or what we may also call sideways action. So by identifying the type of trend price is trading in, we are able to structure our trades accordingly, and also be on the lookout for any news related to production and production cuts or production increases and supply changes as well. And also you can track like the EIA crude oil inventories, which come on a weekly basis, right? You can use that to um, to determine whether demand in oil is picking up or is it slowing down. So that reminds me. So this is what the website looks like. I showed you the link earlier. So what we are looking for is commercial crude oil excluding lease stock. So click on that, and we can click on graph. Okay, so let's just zoom in. So this is showing us data, weekly data uh, for inventory since 1982. So let's just zoom in over here. So you just highlight this part, and it automatically zooms in. So as you can see, yeah, okay, so 2022, yeah, so from 2023 onwards as well, you could see crude oil inventories building, right? So when we say the crude oil inventories are building, they're going higher, right? And then they peaked in about towards the end of March, and they started uh, falling. So this means as inventory falls, that means the drawdown is larger. So when you have larger drawdowns, it means potentially demand for oil is picking up. So that is why you could see as well in the first half of 2023, relatively, okay, although there was a drawdown, but price was just more or less consolidating. So even though it was inventory was building, price wasn't significantly dropping at all. It was actually just ranging. So that is why it's also important not to take any use any indicator, technical analysis indicator, or fundamental data point in isolation. It's good to combine two or three technical indicators, and another two or three fundamental data points, and see if they all line up together, and then try and assess what is actually happening. Oh, sorry, polls are still up. Okay, let me just close the poll. Apologies. Okay, and I'll go through that part again. Sorry, just let me close the poll. Right. Okay, sorry. Okay. So okay, what I was trying to say is okay, I didn't realize the polls would be blocking the screen. Sorry. Okay, so this is one of the website I was mentioned earlier. Right. Okay, so what we are looking for is commercial crude oil excluding lease stock. So you can click on it, go to graph. So you can see here these are the levels here. So generally you can see this is all updated on a weekly basis. So you can see, like I was saying, inventory bills generally means demand is falling, and we have inventory drawdowns generally could mean that inventory is demand is picking up. And similarly, we can look at the SPR, and you can see it has basically fallen off a cliff down to about 360 million barrels. And the other potential, well, not another, one other potential catalyst for oil prices could be when the US government starts to refill the SPR, right? Basically, SPR is Strategic Petroleum Reserve, right? So eventually they will have to refill it and build the inventory back to the previous levels, or close to the previous levels. Now, how aggressive they will be, it all depends. And when are they going to actually come into the market and start buying barrels of crude? So that's something to just be aware of. And witnessing. should be seeing screen too. Sorry, we see you and not the screen. Do you guys still see the screen now? Because it should be showing my screen because that's what I have it set up as. Right? Okay. So right. Okay. Sorry. Yeah. Right. Yeah. So another thing to look out for would be when the US starts to refill the SPR. Look out for debt ceiling negotiations. The outcome of the debt ceiling negotiations. Remember, if failed breakdowns lead to a potential government lockdown, then we could see oil prices pulling back as well. And these are the current support and resistance levels that we have on. This is a 4-hour chart, and yeah, so this is what we have for the moment. Yeah, so look out for any potential news on SPR refills, the outcome of the debt ceiling negotiations. Look out for PMI data for China, Europe, EU. So at least you can get a sense of the economic activity in this big from these countries and the EU region as well to determine whether we see further growth, because when we have economic growth, all prices would be supported. And yeah, I guess this are some of the, and of course look out for OPEC, right? Pay attention to what OPEC is doing, because anytime they announce any surprise production cuts or increases, it's going to have a huge impact on oil prices. All right. Okay. Thank you everyone for today's session. I hope this has been good for everyone here. And yeah, there'll be a short survey at the end of this webinar as well. So please do fill it out and let us know how we can improve this webinar as well, and also what other topics you would like us to cover in the future as well. All right. So thank you everyone once again. All right, take care and have a good trading week. All right. See you.